We just got another hot inflation report for February. The February producer price index inflation numbers, or wholesale prices, which is the prices that businesses face, are starting to be on the rise again, and pretty much so. And most of this, I think, is due to energy and gas costs. Month over month, it rose 0.6% compared to the 0.3% from last month. And then if you take out food and energy for core PPI, that's still hotter than expected at 0.3% versus 0.2%. Year over year for PPI came in at 1.6% compared to the 1.1% estimated, and then core PPI came in at 2% versus the 1.9% estimated. This shows that inflation is still pretty hot, and this is something that I think the Federal Reserve will need to look at a little bit. Will need to look at a little bit more. They may. This may make them extend, rate cuts a little bit later into the year by looking at this data, because inflation's still hot, and this shows that goods inflation is slightly on the rise again, and goods inflation was decelerating for a while. And PPI is often a leading indicator of CPI inflation. So we might see more higher prices at stores now because businesses are facing higher costs again themselves. Look, these numbers still aren't bad at all, but it shows that the trend of decelerating goods and wholesale PPI inflation might be starting to go up again. Is something the Federal Reserve wants to see. This shows ultimately that the economy is still very strong and mostly driven by earnings growth and productivity gains by AI and tech spend. But this is something that the Fed may want to think about in their calculus for rate cuts. Look, I still think they should cut later this year. That doesn't mean that they will. And it's even possible that they might have their first cut into 2025. Yesterday, I was watching an interview by Ken Griffin and Sarah Eisen on CNBC. And Ken Griffin said that, the Fed's keeping rates, high for a while, but the government spending and pretty much the onshoring and manufacturing and production due to all the geopolitical tensions that we're seeing are inflationary forces in their own right. So those inflationary forces are going contrary to what the Fed's trying to do, and they almost cancel each other out, which ultimately Ken Griffin thinks is why the Fed shouldn't think about cutting rates just yet. And he's worried that if the Fed cuts rates soon, that the economy would reaccelerate further again. It might put them in a position where they might have to hike interest rates again. And he thinks that wouldn't be a good thing. And I kind of agree with him too. At first, my opinion changed. I thought, we should do rate cuts soon. I still kind of think that way, but Ken Griffin really made a good point that the biggest mistake and thing that would spook the markets is if we start cutting interest rates, inflation and the economy really accelerate a little bit too much, and then we're in a situation where we have to raise interest rates again. And then I wanted to touch on two more quick things. First, another thing is that retail sales were a little weaker than expected for February, which will likely go into the GDP data for Q1, because consumer spending is about 66% of GDP. And then unemployment claims were slightly weaker than estimated. So factoring all this in, the market's actually shrugging this off and is trading slightly up to flat. We obviously have to see how the market closes. But all in all, this PPI inflation report is something we have to watch next month to see the trend of producer inflation.